I held off on making this video for a really long time. Well, I guess it was really only about like a week I held off on making this video, but I always try to keep my opinions out of things, and I've just seen a lot of videos with, the thumbnail of somebody making some ridiculous face like the world is crashing down burning, and they talk about, is the stock market overvalued? Well, it is a discussion that I feel is worth having, and it's something important just to hear different insights or ways that you can come to this conclusion on your own. So let's talk about if I personally think if the stock market is overvalued. Hey everyone, and thanks for joining me today. My name's Matt, and again, as I mentioned in that intro, what I want to talk about today is if the stock market is overvalued. A lot of people have been asking this question, or it's come up a lot more frequently because they want to know, is now a good time to buy? Are we going to see a dip again? Is it going to crash hard? Am I going to lose everything? There's a lot of reasons why this question comes up, and I just wanted to share my insights or my thoughts about this and hopefully give you a little bit better of a way to make your decision for if you feel that the stock market is overvalued. So before we really jump into this, I always want to mention that this is not a new discussion. This has been kind of floating around the industry. I've been hearing it in podcasts, news reports from clients that I had really since around 2016. And there's a few reasons why 2016 stands out to me the most as when this discussion really started. First one being is they say on average a recession happens every 7 to 8 years, and given that the previous recession, the '08 recession really starting in 2007, was 7 to 8 years before 2016. So that was the first indication that people were maybe thinking that we were headed towards an economic downturn. Second one is it was an election year. Election years always throw off the market a little bit because, there's going to be winners and there's going to be losers, and that's just kind of how it is. The third reason, though, is it's also when Brexit happened. So I think this was about July 7th, if I can remember correctly. Probably not correct. But when basically Brexit was announced, it's a thing, it's going to happen, or when it started being voted on, the market took a huge downturn. And people definitely reacted to that kind of news poorly. People were selling out of their investments. They were trying to keep everything in cash because they thought this was going to be an issue that affected everybody globally. The downside to that, though, is about 2-3 days after that news of Brexit, the market completely recovered and was totally fine. So a lot of people lost a lot of money and really sold at a horrible time because they thought the world was going to come crashing down, not investing for the long term, and really let their emotions get the best of them. So a lot of people lost a significant portion of their portfolio from reacting to Brexit news. So those three things alone made me say, as this new finance expert, that hey, everything's going down, let's start preparing for a recession. And I was wrong. I was very wrong. The market, once Brexit news came out, even through the election, just continued to climb and climb and climb, all the way up until December of 2018. Now, in December of 2018, there was a few things that happened that made the market take a turn again. The first one was the trade tensions and trade wars with China. Again, I'm not a political person, so I'm not going to even really talk much about that, but I know that left a lot of investors with uncertainty about the direction of where the market's going to head. The other thing that happened in 2018, December of 2018, was there was that big buzzword, some of you might remember, called the inverted yield curve. Now, as I've mentioned before, bonds are not my area of expertise, but just to make that simple, if you didn't know what that inverted yield curve meant, so bonds with a longer term duration have a higher yield. Basically, they pay more money because it's more risky. 30 years from now, who knows if you're going to still be able to make those payments. So for the time being, they just pay more than something that's going to mature in a year because you only have a year left of making those payments. Odds are of a company making that within a year makes sense. So again, more simply put, the longer duration is for a bond, or the longer until it reaches maturity, generally the higher the yield you'll see because you're taking on more risk of not receiving those payments in the future. Shorter term, lower payouts because less risk of receiving those, or of not receiving those payments in the near future. When the yield curve is inverted, and what happened there was the 10-year yield on treasury bonds was actually lower than what it was on 2-year bonds, which is what created that inverted yield curve. And honestly, that's where I'm going to leave it, because bonds, interest rates, par values, all that, it's pretty complicated stuff. And I talk more about stocks and ETFs than I do with bonds. But those two factors, so again, trade wars and tensions with China and the inverted yield curve, caused another downturn in 2018. Well, once again, a few days into 2019, we saw the market completely turn around again. And from that point, it really did continue to rally until present day. And I guess like this really all started maybe around the end of February is when 2020 is when we saw the first dip again, really since that event in 2018-2019 era. So I feel like in a lot of videos that I've seen, when people start talking about present day fluctuations in the market, a lot of people start to talk about this as if the stock market is the economy. And I just want to clarify here that the stock market does not equal the economy. The stock market is a leading indicator of the economy's performance. So it's one of those that you can determine, one of the many factors you can use to determine the direction or help you determine the direction of the market, of the economy, but it's not the tell-all sign. There's a lot more other things that you can take into consideration. We're not going to get into that today. If you want me to, I can gladly make a video talking about those indicators and how you can determine the health of the economy itself, but just wanted to clarify that here. We're really just going to be focusing on the stock market itself. So why is it that in the midst of a global pandemic, of businesses being shut down, businesses actually filing for bankruptcy at record numbers, as well as really high unemployment rates, why is this market still continuing to climb? I don't think anybody can exactly pinpoint why the market is going back up, but I have two thought processes behind there. The first one is that unemployment has become more accessible than ever, and I'm sure we've all heard some people are actually making more money off unemployment than they are from working in their job that they previously had. And so some people are now almost better off with unemployment than they were, working whatever they were doing prior. And also, self-employed people now have the first time ever that they could take advantage of unemployment. So somebody like myself, I'm a real estate agent, so I am considered self-employed, and I have the ability to take advantage of unemployment because, market's taking downturn. We'll leave it at that. But it is one of those that the numbers right now for unemployment are so high because more and more people have the ability to take advantage of it. And what that does is it creates a financial cushion for themselves that they're actually able to use some of that excess money that they now have and put it into investments. Now, the market is loosely driven off trading volume, so if more people have extra money or extra cash on the side that they're able to invest, they're going to put that into the market, again, driving up that trade volume, which in theory could increase the price of the market. It can do the same if people are pulling out, but I think more and more people are starting to invest into the stock market because they saw the trendy headline of market takes huge dip. Wow, I just got this stimulus check for $1,200. Let me put this into this dipping market. And that actually brings me to my second point. If you look at a graph, and I know, and you should know too, I don't really look at graphs, but I thought this was very interesting. So March 23rd, news came out that a stimulus check was being handed out to people with all the stipulations and whatnot. March 23rd is also the first day that the market started to recover. So there is a correlation there, at least in my opinion, because that doesn't just happen on accident. That when they announce a lot of people are receiving $1,200 for free, that the market just goes back up again. A lot of times that can actually negatively impact the market because the Fed is essentially printing money. And when you start printing money, you're going to hurt inflation, which is ultimately going to weaken the dollar's value against other economies, which we can go into a long rabbit hole about that. But those two factors alone are why I think the market is propped up right now, or why it's continuing to rise. Now, is this going to last? Is this going to be forever? That is what we don't know. But what are my concerns here? Well, I'll make this part quick here because I can really go on to a long tangent about my concerns. The first one is mortgages. So a lot of people have had the ability to kind of hold off on their mortgage payments for the time being. You wouldn't have the ability if you were renting to be evicted, which is nice because people basically don't have to pay rent and they have this extra cash. For those though with a mortgage that haven't been paying their mortgages, when the banks decide that you need to start making those again, a lot of people are going to have to owe what they missed. And that's going to create some issues, because if you didn't have the money to pay your whatever it is in mortgage for 1 month, what makes you think you're going to have it all of a sudden to pay for 2 months, 3 months, 4 months, unless you've been properly planning for that? So a lot of people are unfortunately going to have to go into default on their mortgage loans and then have to go into foreclosure on those, which that is going to negatively impact the economy, because it's going to hurt people's buying power. Loans are a way too that the government kind of gets money back through interest rates and whatnot. So if people aren't able to borrow money because they've had to foreclose recently, that can really hurt the overall health of the economy. Another concern that I have is that Warren Buffett is not buying anything, and he's sitting on a record amount of cash. Now, Warren Buffett is a value investor, and he invests in the stock market. So when he's looking for a good deal, he might not be seeing anything right now. That doesn't mean that there's not any buying opportunities out there. And he's a little bit old school when it comes to his investment styles. You know, he loves companies like Coca-Cola and Geico Insurance. So he's not really going to be somebody to look into a company like Zoom or Peloton or Pinterest, Etsy, companies along those lines. So because Warren Buffett isn't buying anything, doesn't mean that the opportunities aren't out there, but he's an incredibly smart person, and I know that Warren Buffett knows a good deal when he sees one. So, you know, it's just something to kind of watch what he does, given his track record of success when it comes to handling multiple economic downturns or recessions. And it's also an election year. Again, 2020, we're in an election year, and that kind of always throws the market into a frenzy. So be wary as we approach the end of the year. Know that these are all three of these, maybe except for the mortgages, are all short-term effects on the market. Because I know I said with mortgages, people aren't necessarily going to be paying them back. That can hurt them on an individual basis in the long term. But for the US population and for the stock market itself, I don't think that would have a very long-term effect. Maybe 6 months is what we can see from that. Warren Buffett buying, when that opportunity comes, he'll buy. And again, that could be long or short-term, just depends how long it takes for that opportunity to come up. And then election year, that's always a very short-term thing. I think it takes 3 months generally to recover from any kind of downturn during an election year. So the good news here is the uncertainty, to me at least, is short-term. Now, I know I really haven't addressed the question that we have though. Do I think that the market is overvalued? I'm not sure, but I personally do believe it is currently overvalued, but I'd also be lying if I said I haven't been saying that for the past 4 years. So I think personally, yes, the market is overvalued. I think I've been saying this for a long time though. And even while I've been saying I think it's overvalued, I've still continued to make purchases into companies. And I've still continued to purchase stocks and ETFs. I generally invest in ETFs when it comes to myself, but I also take a look at stocks and will occasionally buy stocks from my own personal account. And my thought process behind that is, if I'm able to buy a stock, let's say that the market takes another dip, and the ETF or stock I buy takes forever to recover to where I bought it at. Well, I've been consistently buying that over time, so I can now use that really expensive share I have, if I need to sell, as a way for a tax strategy. I can write that off as a loss instead of a capital gain to help me when I need access to my money. Yeah, I guess in theory you're saying I'm losing money, but I'm also using that as a tax strategy to minimize how much I would have to pay in capital gains. Also, the PE ratio for the three major indices that we have in the US, which is going to be the NASDAQ, Dow Jones, and S&P 500, are all up from the previous year by a decent amount, but none of them are over 30. They're all actually sitting below 30. One of them is at 29 right now for their PE ratio. And again, too, that's a loose, very loose indicator there, not something to make a decision off of. But to me, that kind of indicates that stocks are not necessarily trading at a premium right now. They're about to be, absolutely, but I would be a lot more concerned if one of the PE ratios for those three indices was at like 50 or 60. That is when I would absolutely say, yeah, I think the stock market's getting completely overvalued. Maybe we need to hold off right now on what we're doing with our investments. But since they're all under 30, again, it just throws another curveball into it, and it makes it a little bit harder to determine exactly if the stock market is overvalued. So what can you do during this time? Because I know I didn't give you a good answer there. So my best tip, not advice, just a tip, is to use this time to review your portfolio. See which kind of positions you have that you feel probably aren't going to go any higher. Maybe use that to start slowly selling out of these investments, while also making sure you're doing your research to see which investments you actually need in your portfolio. Figure out a way that you can come up with a price that you'd be willing to pay for that position, and then just monitor it until you're able to buy it at that price that you feel is a good buy for it. You know, it's time consuming, yes, absolutely. But it's just something that you kind of need to be doing with your portfolio if you're not working with an advisor. And if you're not working with an advisor and that sounds too time consuming, now's a great time to look for an advisor then, because when the market goes crazy, the advisor is really going to help you out with your decisions, creating a plan for you, putting investments into places that are going to help you with your overall personal financial goals, and really just make sure you're set up well in the long term. So again, my tips for right now is do your research, don't let emotions control your investment philosophy, and find those stocks that are going to be a good fit for your portfolio. So sorry that I didn't necessarily have a straightforward answer for if the stock market's overvalued, because that's my personal opinion. Everybody's going to view this differently. Some people might think it's undervalued, majority think it is overvalued, but it's up to you to make that decision, because again, your portfolio is different than mine. It's different than your friends, your moms, your brothers, whatever. So bear that in mind as well. This is all about you and your personal financial situation, and if you ever need assistance, please speak to an advisor. Doing your research on YouTube is definitely a great place to start, but if you're still not comfortable, please have a professional take over for you. There's a reason why they went to college for this. They've taken year-long tests to get into the position and give you this advice, so don't knock them because it's a paid service. It can really help you out financially with your goals. Anyway, with that said, I really appreciate everybody's time today. If you thought this video was helpful, like it. If you think I was just ranting for no reason, then definitely hit it with a thumbs down. If you want to subscribe, I would so much appreciate that. We are at 96 subscribers, so I need 4 more to get to 100, and that's just so crazy to think about. You know, 100 people, I don't even think would fit in my house. So it's crazy, and I'm just so appreciative of everyone out there that has taken the time to like these videos, leave comments, and subscribe to it. You know, certainly want to keep this trend going. I love that everybody's been enjoying these videos so far, but please let me know if there's anything I can do to improve them or make them more enjoyable for you. As always, you could be anywhere in the world, and you're right here with me, so I really appreciate that. Thank you so much for taking the time out of your day to watch this video, and I will see you Wednesday for a very special Watch This Wednesday. Take care.